Goldman Sachs said over the weekend that they expect the Fed to cut rates by 50 basis points by the Fed's March 18 meeting. They're not alone, of course, and now the president is piling on once again, tweeting about the Fed. Our own Brian Cheung, who covers the Federal Reserve, is with us here now. So Trump wasting no time saying the Fed should act.
Not at all. I want to read you what he just said in his tweet. This was fired off about 10 minutes ago. He said, as usual, Jay Powell and the Federal Reserve are slow to act. Germany and others are pumping money into their economies. Other central banks are much more aggressive. The U.S. should have, for all of the right reasons, the lowest rate. Putting us at a competitive disadvantage. We should be leading, not following. This is coming after some commentary from markets that maybe there should be a coordinated lowering of interest rates around the world, which does seem to square a little bit with what President Trump is saying here, although we haven't seen any sort of easing from the European Central Bank yet. We did have a statement from the Federal Reserve on Friday afternoon saying from Jerome Powell that they would use our tools and act as appropriate to sustain the economy. And then we actually did hear from the Bank of Japan last night, them saying they would strive to provide ample liquidity and ensure stability in financial markets. But Julie, you mentioned what the markets and investment banks on Wall Street, at least, are saying about all of this. Goldman Sachs saying they are forecasting more monetary easing. They actually increased their forecast over the weekend by saying they expect 50 basis points of cuts in its March 18 meeting, or by the March 18 meeting, maybe hinting at the possibility of a emergency cut. And then they expect another 50 basis points in the second quarter of this year. That aligns now with Nomura and Bank of America, both of which also forecast 50 basis points of cuts in that March meeting. For what it's worth, Goldman Sachs has also lowered their GDP estimates for the United States, forecasting more of a U-shaped recovery as opposed to a V-shaped recovery. If we break down the quarters based on what their economics team released this weekend, they expect 0.9% GDP growth in the first quarter, 0% growth, no growth at all in the second quarter, with a small bounce up to Q3 of 1%. And then lastly, returning to somewhere closer to normal at 2.25%. This is a market downgrade. They said the coronavirus would shave off about 1% of GDP growth for the Q4 to Q4 year-long period. So again, implying something more of a slower recovery than maybe those who had previously said would be a V-shaped recovery had originally hoped for. This is also in line with what the Bank of International Settlements, which is a cohort of about 60 central banks, said last night, where they said that a quick recovery seems, quote, grossly unrealistic. So not necessarily a great bellwether, but back to you, Julie and Adam.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.